If you want to learn how to trade the markets, this is probably the best video that you're going to watch in a very long time. And it's based on 8 years of experience, over 11,000 hours of chart time. And I'm just going to give you 20 practical insights. This is based on what I learned myself through trial and error, what I learned from my mentors, from maybe the best traders in the world, actually. It's based on hundreds of books, podcasts, seminars, basically everything that you probably are kind of going through individually. It's based on principles of some of the best traders out there, like Mark Minervini, Christian Kou Paul Tudor Jones, Jesse Livermore, people like that. And yeah, let's just jump straight in, and hopefully it's going to give you some ideas and improve your game. So first, let's just start off with the understanding that you need to build a strong foundation, which is basically a couple topics that are related to this that I'm going to go through. And the first is all connected to managing expectations. So this is a great meme that kind of shows the principle behind it. When you come to the market, right, or when you read about trading or investing the first time, you're basically, I forgot his name in Squid Games, but you're basically him at the top, right? You're naive. You are in the unconsciously incompetent level of awareness, right? You don't know what you don't know, basically. So you think it's going to take maybe a year, maybe two, maybe three, whereas in reality, this is going to take many years for most people to master, if they can even do it. You will constantly be asking people like, oh, show proof, or show me your backtest, because that's what you think is actually applicable to everything related to this. You are excited to enter trades and you just want to make money as fast as possible, right? Versus a more seasoned trader like the when he's in the bottom and he already went through the Squid Games, right? That is essentially you in a couple years, if you put in the work and the effort, to bring yourself to a level where you've refined your craft and your skill. You're more patient, you're more skeptical, you're more pragmatic, you're open to ideas from others, even if they don't have backtests, because backtests are basically BS anyways, unless you're an algorithmic trader. So it's just a very different person that is you I'm talking about that will come out of this journey, right? And I made software to significantly help you shorten that journey, but it's up to you to still do the work. So I think a good way to think about it is, there's going to be a lot of work and a lot of years in the shadows where you basically think this is pointless, right? Like, why am I doing this? I'm studying all the time. I'm making trades, but I'm losing money. Everyone else is moving ahead, stuff like that. And then, there's going to be small breakthroughs. And eventually you'll have a very big breakthrough where you essentially will be able to consistently do very well in the market. And when I say very well, just for reference, right, there are a lot of self-made traders who don't come from finance, or some even didn't even finish high school. They were musicians or police guards or whatever. And some of these people went on to make hundreds of millions in the market. And no, they didn't start out with hundreds of thousands either. Most of the traders actually started maybe with 25K or less. And it's a result of many years of work and effort and refining the craft, because it's a scalable business model. It's a scalable source of income, but it's not for many, right? It's only for the people who are really interested in making it. So let's move on to the next. I think it's very important. It's something that I don't see discussed enough, in my opinion, learning how to learn. So when I was starting out trading, right, and I used to trade FX, unfortunately, which is a very rigged market, definitely don't trade FX or crypto for that matter. The problem is that you're consuming a lot of content, and there's a very fine balance between consuming content and actually doing deep work. And there are a lot of books written about deep work, like the one from 𝗙𝗢𝗪 is a great one, where you are really moving the needle, so to say, right? So, for example, there's a difference between you watching a gazillion videos on trading or investing, which is important, don't get me wrong, versus you going through your setup and taking like a gazillion screenshots and just memorizing your setup and trying to understand the nuances there. Very focused. Like when I'm trading or doing anything nowadays, to be honest, it requires like my attention. My phone is on silent. I don't switch tabs. I don't listen to music. I make sure that, physically I'm comfortable and I don't need to eat. I don't need to go to the restroom. Like I'm just there for at least 2 hours to get into the zone. And this is going to be very important in terms of time as well. If you have like a job or a family or whatever, and you only have a couple hours in the evening or in the morning or in the weekends, you need to make those hours count double. And the way you do it is by understanding presence and being very focused. So it's a lot about learning how to learn. And that again comes down, I'll cover it later, but basically, you want to go through things like related to discovery. You want to make sure that you discover new things, like maybe this post or whatever, that will give you new ideas. But then you also need to really study, right? Like, so if you're reading a book, like really check what they are claiming, really see it with your own eyes, stuff like that. The next thing that I think is super important to understand, which is not discussed enough either, is the natural market cycle. This comes in a lot of different levels. You have very long market cycles that are 90 years or so, which is called a 𝗙𝗢𝗪 cycle, if I pronounce it correctly. We have a jugular cycle, which is a couple of years. We also have cycles on a daily basis or a monthly basis or a weekly basis. And Dan Weinstein wrote about this in his book. Generally speaking, if you think about the daily chart, right, this is what generally stocks will move through like. So you'll go from a stage 1 accumulation where people loading the boat to a stage 2, to a stage 3, to a stage 4, right? And our goal is generally to buy at the transition of a stage 1 to a stage 2 or somewhere in stage 2, because stage 2 could mean anywhere from like a couple hundred% gain to like 1,000 and up. The problem with stage 3 is that the trend is no longer your friend. It's starting to consolidate. It's starting to get choppy. And then, from 3 to 4, this is essentially a downtrend. And unless you're an active short seller, you should avoid it. Now, why am I saying this? Because again, we want to trade mostly when it's in the stage 1 or stage 2. And that means that you as a trader or as an investor should completely ignore, in my opinion, unless you really know what you're doing. And that means like you have 15 years of experience and like, I don't know, you have a house in the south of France or whatever the fuck it is. But like you really know what you're doing. And then you buy stocks in stage 4, meaning stocks that are clubbed to death. And these are basically zombie companies. If you look at the IPO from Bumble, for example, right? It IPO'd at 38. And then basically it went down and it kept going down. And it's now maybe at $2-3. I'm sure there were a lot of people who bought it at 8, thinking that they were smarter than the market, hoping that it was going to go into a stage 2. But it wasn't. It was a stage 4. A stage 4 end of the trend, basically. So you want to just focus on stage 1 transition to stage 2 and stage 2. Then let's talk about indicators. I could talk about this for hours, and I might do a very in-depth video and post someday about, different ways to think about indicators. But if you think about indicators in general, all of them, right, without exception, are basically a combination or a single measure point visually of price, time, volume, and or momentum. That's it. There's nothing else. So whether you use an RSI or MACD or whatever, it doesn't really matter that much, although I do have a preference for some, as I'm sure you do as well. That being said, the best indicators that I can guarantee you almost all traders will agree with, unless they have a very different strategy, is the 10, 20, and 50 moving average. You can use exponential or simple, it doesn't really matter. And dollar volume or regular volume bars. That's basically it. I like to look at the 200 moving average as well because I want to see it slope up. But this is all you need. And this is what 𝗙𝗢𝗪𝗧𝗥𝗢𝗡 also referred to as magic lines, because these lines are going to save your ass and they're going to allow you to trail your positions better. It allows you to recognize setups better. It allows you to spot institutional buying, stuff like that, right? So I would really recommend anyone, unless you have more than 5 or 10 years of experience, to just focus on this. Like, I'm serious. Like, it took me a very long time to come to this conclusion, but hopefully I can save you a couple years just by emphasizing this. Yeah, and we'll go through some setups later and why these work. But, in terms of indicators, this is what I would do. And then there's one more thing that I think you could check, which is a 3-9 MACD, which allows you to spot dips more easily to load the boat, basically. But that's it, yeah? So why am I sharing all of this? Hopefully you can see just by the basis of how I write or how I speak or how I present this, that I'm all about the essence. Even with a platform which is called Spiceliner that I'm building myself, I'm trying to condense everything to the essence of it, because my opinion is that the market is mostly feeding you too much information and bullshit, and everyone is trying to overcomplicate it. But I think it's very good when it comes to your chart or your process or the tools that you use to simplify it as much as possible. It's going to be much easier for you to make decisions if you keep things simple. That's the same with the indicators. If you have a gazillion indicators on your chart, well, some are going to fire and going to say, well, this is a buy moment. The others are going to say this is a sell moment. Then you switch time frames and now everything is scrambled and you just get confused. That's why the power of simplicity is, like, I would not underestimate it. This is really, really going to help you as a trader and investor for that matter. So yeah, you can go through the financial statements, all this sort of stuff. You need to do your fundamental research, in my opinion. But in the end, right, it's a lot about understanding what matters and what doesn't. One of my favorite movies is actually Kung Fu Panda. I don't know why, I just think it's super funny, but it's also a great story because, Kung Fu Panda, if you haven't seen it, but I'm sure most of you have, in my opinion, is really about, Po, right, finding his own style, finding his own preference. And when he starts out, he wants to learn Kung Fu and everyone laughs at him because he's just a big, fat, fluffy panda. But he becomes a Kung Fu master, right? Nobody can really hit him because it bounces off his fur and fatty belly. He's like super agile and fast and strong. He's like a very interesting eclectic mix of these kung fu styles that tiger or whatever grasshopper have. And the reason I'm saying this is, I think this applies to a lot of things in life, but especially in terms of trading and investing. You need to find your own style, right? Your own personal preferences. So take what I say, and if it resonates, that's great, apply it. But if it doesn't, then you should just ignore it. That goes for anything that you read or discover online that maybe some of the best traders in the world are doing. If it doesn't resonate with you, just get rid of it. You need to find your own style, and I think that applies to many facets in life, but especially in trading and investing, right? And what you want to do is, or what's probably going to happen is, you're going to try and emulate different styles. You're going to try and copy different people, but in the end, you're going to find your own style as time progresses and you put in the work. So this is something that you can't just take a shortcut and find your style. This takes years to develop, to build conviction in your setups, for example. But it's going to be super important and super helpful for you. Just have a look at what actually moves stocks, and there are a couple topics that I'll go through with you. And yeah, it's about stuff like how I scan, market conditions, so on and so forth. So let's just continue from here. So there are a lot of ways to understand market conditions. Pradeep refers to this as situational awareness, which I think is a beautiful term that kind of captures the essence of it. But basically, you want to know, right? Like, I like to look at it as surfing. You can be the best surfer in the world. You can have the best surfboard. You could have trained for this moment for years, but if the right big wave isn't showing up, if the wind isn't there, then you're not going to catch a big wave. So you can only surf when the conditions are right. So you need to be very aware of the context. So you look at market, sectors, industries, stocks. You look at stocks, industries, sectors, markets. Yeah. So it's like a process where you take a top-down and a bottoms-up approach. At least that's how I do it. But what I do every day, without exception, is I look at the NASDAQ, so the QQQ, and I look what it's doing. Because that is the essence of the US economy for me. And the US economy, let's be real, is basically, the majority of the global economy in terms of stocks. Yeah. I'm not talking about potential impact 20 years from now. I'm talking about today, stocks. The Qs, if you would plot it on, just a 20 moving average, generally speaking, you will see that we're in good conditions, bullish territory, if either the slope of the 20 is positive. So I don't know if you can see my mouse, I hope you do, but at one point, right, it starts to slope up again. This is a very bullish sign. You can be very sure that most of the stocks in the US market, at least in that point in time, and definitely the big tech, are moving up. They're gaining ground. But if it's sloping down, you should be very careful, especially if it's below the 20. And I personally don't do anything if the Qs are below 50. Like, it's best to sit in cash, in my opinion. Maybe you buy the dip later, but that's very advanced. I'm not going to cover that now. So a very simple trick to, get a feel for the market is you look at the Qs and you look at the slope of the 20. And you look if price is trading above or below the 20. If it's above, good. If it's below, bad. If it's kind of, chopping around, be very cautious. That's one way. The other way is you can look at IWM, which is the Russell 2000. And as my mentor also taught me, if the institutional investors are having a risk-on mentality, generally speaking, they will be more speculative in nature, obviously. So they're going to go into small cap stocks, maybe mid caps, and that's expressed in the Russell 2000, the IWM. So you just look at the chart. If it's, making a big bull candle, it's probably a good sign because it means the institutional money is flowing into it. Another way, or another thing that I want you to be aware of is you need to look at the VIX. The VIX, anything below 15 is perfect trading conditions. I don't trade above 20 when the VIX is 20 because, when price is very volatile, it measures volatility, right? The price is erratic. Like your stops are getting chopped down, your P&L is going to fluctuate way too much. It's just not good, good grounds for trading, to be honest, and you're better off just doing nothing. And then lastly, you can look at sectors. So just as an example, I also have this on my site, but as an example, you can look at 11 sectors and see if they're generally up or down, how many stocks are trading above the 50 moving average in that sector, generally speaking, which sectors are thriving, so on and so forth. So sounds like a lot of information, but I don't have kids. But if I would have kids and I would teach them how to trade and invest, I would say just look at the Qs, look at the VIX, and that will give you 80-90% of what you need to know. A very important concept as well is sector and industry rotation. So just so you are aware, there are about 6,000 stocks in the market. There are 11 sectors, and there are, depending on how you count it, anywhere between 50 to, let's say, 100 industries within those sectors. Now, you have a concept called sector and industry rotation, and all this basically means is that due to external events like geopolitical tension, some sectors and industries will be hotter than others and more in more demand, which makes a lot of sense, right? If we're going to have an energy crisis, then maybe stocks in the energy sector are going to boom. So you would see energy as a leading sector. Right now, or at least in this example, you could see like, okay, industrials and consumer discretionary are hot sectors. We have like, In those cases, 62 to 63% of the stocks are above the 50-day moving average to that extent. And these are leading industries, or leading sectors, sorry. And what I mean with that is, generally speaking, you will have 2 to 3 sectors that are thriving. And within that, you will have a couple industries that are absolutely thriving. You want to pick the best stocks in those industries. So generally speaking, like O'Neill also explained in his books, right, who's arguably maybe one of the best traders and investors ever, find the best stocks in the best industries in the best sectors. But how do you know which ones are the best? Well, very simple. You look at sector and industry rotation, because what might be a hot sector or industry today is not going to be a hot sector or industry tomorrow, so to say, right? For example, right now, as an industry, it's not here in the visual, but maybe after the SpaceX IPO, aerospace is going to be a very hot industry. Maybe after that, energy, because now you need a lot of energy to build the data centers and the infrastructure. Maybe that's going to cool down. It's going to be a different industry. So this rotates. And the more you are aware of this, the easier your life is going to become in the end. Then a principle that, I don't know, some people got really pissed off when I pointed it out in some subreddits, but I'm just going to assume, that you don't have 150 million liquid in the bank. You don't have a house in France, and basically you have no clue what the fuck you're talking about. Yet a lot of people seem to think that they have this magic brain and they can buy stocks in a downtrend when it's actually making new lows, which is just mind-boggling to me. If you look at there have literally been academic studies about this, and all the best traders in the world, with the exception of a couple, some just have a very different style, but almost all of them buy stocks in an uptrend. Price is making a higher high, and the essence of what I'm trying to say here is that you buying stocks on a downtrend is, if you really would admit it to yourself, more of a gambler's mentality than anything else. You think that you have information asymmetry benefits that allow you to buy a stock on the dip, and it's going to reverse and do like 400-500% gains in like a week or something. This is just wishful thinking. You have no idea what you're doing. So I would advise anyone to just focus until you're very advanced on stocks in an uptrend making new highs. It's also very important to understand why. So stocks in an uptrend making new highs, defined as making high highs and higher lows, 10, 20, 50 moving average stacked on top of each other with a positive slope. These stocks have momentum. So momentum, you can measure it sort of, let's say out of 100 days, a stock was up 95 days. That's extremely high momentum. And I'm sure you paid attention to physics in class. An object in motion stays in motion. And that might sound very childish for me to share with you and explain it like this, but it's really true. Like, if you really think about it, stocks that are doing well will attract more buyers. They will attract more institutional investors as well. So the momentum keeps going, right? And the market only has 2 modes of operandi, so to say: market contraction, price gets tight, and market expansion. Price gets wide. You make the money when it gets wide, but you get in when it's usually contracting. We'll cover that in a minute. But I just want you to be aware that, generally speaking, right, we're looking for stocks in a stage 2 uptrend to buy them. So we buy high, we sell them higher. And again, there have been a lot of academic studies done regarding this, and this stuff actually works. Okay, so for those not aware, but I assume most of the people listening or watching this are aware of it, I just want to emphasize that if you are a serious investor or trader, you need to scan for stocks. Now, you can use the scanner that I built on Spiceliner. You can use Finviz, although I think it's very messy, but you can use Finviz. You can use TradingView, whatever floats your boat. But you need to scan for stocks, because again, there are about 6,000 stocks in the US market. You need to find essentially a needle in a haystack. That's what you're trying to do. And it's a golden needle, ideally. Now, on my platform, what I did is I removed about 3,000 stocks out of the 6, because those are basically scam companies, SPACs, shell companies, rug pulls, no liquidity, no volatility, the list goes on and on, right? So if you remove about 3,000 stocks, that's basically the basis where I start scanning. But just for illustrative purposes, let's say I start with the 6,000. The first thing I look for is I scan for stocks in an uptrend, this means that they have a rising slope of the 50 and 200 moving average, about 3 to 4%, depending on how tight you want to have it. That will give you about 200 to 300 stocks. I personally like to also have stocks that have very solid fundamentals, which is why I built a very deep analysis AI tool on my platform as well to help you do that. The combination is essentially you want to see accelerated sales and or revenue. We're talking about 25% quarter over quarter or 40% year over year, ideally both. And it could be more as well if you want to have a tighter list. And ideally they're profitable. So I'm looking for stocks in an uptrend that are profitable, that also adhere to what I call my basics. My basics are, it's not too volatile, it's not too slow. So that means they have an ADR of 4 to 8%. There is enough liquidity, so there are about 100,000 shares traded on a daily basis, and it's at least $1 or $3, something like that. So now what I get is I usually get a list of around 100 to 150 stocks. Now I look at my setups, because out of these, let's say 100 stocks, maybe 30 have a potential setup. And out of those 30, let's say 10 are good. And out of the 10, maybe 1 or 2 are actual setups that I want to take. So that's how I scan for stocks. And I highly encourage you to either try and emulate something like this or figure it out for yourself. But it's going to take a very long time, I can guarantee it. Again, you can check out the scanner that I made on my platform if it helps. But just be aware, like, you need to scan for stocks, and this is, in my experience, a great way to do so if you want to trade and invest, kind of like how I do and how a lot of other people do it. A very important thing to keep in mind as well is that all stocks need a reason to move. All of them. There are no exceptions, like zero. It can be based on fundamentals, a very good expectation in earnings that was even higher when they reported it. So now the market is completely missing the ball, and it gaps up, for example. We call this a gap and go. It can be related to a product or something else that is just very good news for the company and or the industry that allows this company now to basically shoot up, right, like a rocket. Another thing that you can look at is macro events. So sometimes, especially for example with the US-Iran war, there will be announcements or things that are going to heavily impact some companies, legislative changes, for example. And this can be a huge catalyst for some of the stocks. Like, these can absolutely be that spark that will just ignite them. It's more difficult. You need to pay more attention to the news. And if you don't want to do that, I completely understand. But I just want you to be aware of the catalyst. And then the third is what people, I think they realize it, they just don't, they might not have verbalized it or made it tangible in their mind, but this is story stocks, right? This is also what Stockby talks about, but we're talking about stocks that they might have shit fundamentals, honestly, probably not profitable, sales are shit, so on and so forth. There's no real macroeconomic event or legislative change, yet they completely blow up. A great example of this obviously was the GameStop saga. It doesn't really matter if you believe in the story. It's important that you understand that there's a story driven by the media or some influencers or some very legit traders and investors. And it creates this hype bubble around the stock, right? And because there's this hype bubble, this, stocks like that can go to the absolute moon. Like, it's just insane, the moves stocks like that could make. In my experience, the best ones, which is extremely rare, have some sort of combination of these three, right? I think actually, just because it just went IPO, I didn't buy the SpaceX IPO, but the SpaceX stock in itself, I will buy it on a dip, does adhere to a lot of these. They have generally great fundamentals, many billions of revenue that is expected to grow even more because the sector is becoming hotter in aerospace. Great story. I mean, it's arguably built by the greatest industrial entrepreneur of the modern world, Elon Musk. And then we have also a macroeconomic event, which is that, in the future, maybe the US government wants to invest more in SpaceX or outsource some of the work that NASA used to do to SpaceX, stuff like that. So these are extremely rare opportunities. I'm not saying you should just go and blindly buy stuff like that, but I just want you to be aware of, what are the reasons that the stock actually moves. And then apart from all of this, of course, there's supply and demand and sort of what they call the market auction process, where, all that the market is trying to do is try to find a fair price and exchange of value. But these are the ones that allow a stock to really make a big move. So let's just talk about, okay, this is great, but how do you actually make money, right? Well, I mean, apart from the obvious ways to make money, which is, you buy blindly and you sell blindly and you get lucky. A better way to think about it is to think about it in probabilities and outcomes. Now, I'm a bit lucky here because I used to play professional poker and I've always loved games that had this sort of probabilistic aspect to them. Generally speaking, right, a lot of traders in particular, investors a little less, they'll talk about R multiples. What is an R? Let's just say for now it's a risk unit, right? So if you have an account, let's say, I'm just going to make it simple. Let's say it's 10,000 in the account and you risk $100. That's 1% of the account. Now let's imagine that you take 3 trades in a row and you lose all 3 of them. You're down $300. But now on the 4th one, you make 15R. Yeah. So you made 1,500. Your total net profit would be $1,200, i.e. 12R. And the more you understand this, the more you can let probabilities work in your favor. So you're not just only going to look at having the wind in your back in terms of a stage 2 uptrend, an uptrend in general, good fundamentals, a good catalyst, a good setup, which we'll cover in a minute, but you're also going to make sure that you enter the right time and place with a tight stop, ideally, to optimize your R multiple potential. So you could have a very low win rate and still do extremely well, just because, as I say, the math is mathing, so to say. And there are many traders that have a win rate of less than 30% and they make absolute fortunes because their big couple of stocks that they back are not 15R. They are 50R or 100R, and those are account and or life-changing amounts. And I think people need to understand this better. It's very interesting. I had a friend of mine, and he's probably one of the smartest dudes that I know, and he called me up once, and he wanted to buy this stock that was extremely overextended. And it kind of surprised me that even someone as smart and intelligent as he was, and still is, wanted to buy when it was very obvious that the stock was not going to make another move from a 10x perspective, because the stock went up from 20 to 200. So you need to be aware that you always want to have this asymmetrical upside, so to say, right? Nassim Taleb also wrote about this concept in his book, Anti-Fragile. I highly recommend anyone to check it out. But be aware that, if you try and pick stocks that have the potential to like really go to the moon, right? Where you have a very optimized R multiple potential. Don't buy them overextended. Don't buy the hype when it already went 10x, because you're going to be too late and you're going to screw yourself over because the probabilities are not going to work in your favor. You're going to risk 4R to maybe make 2R. That makes no sense. Just go to the casino, get drunk, and that's what you want to do. So R multiples, very important. So what are the entries and setups that I look for? Essentially, these are the three. There are a couple others, but I think they're pretty advanced and I don't want to confuse people. So let's just cover the main three. The first is breakouts. Breakouts to me just means, okay, there's a tight base, which can be a flag, high tight flag, or just a general flat base, or VCP, which is coined by Mark Minervini as well. Price gets very tight, it breaks a previous high and high volume, and off we go. It's surfing the 10 and 20 moving average, or sometimes the 50. This is a great setup, and it works. If it doesn't work at scale, the market is probably not in a good, it's not a good time in the market. And then if you would check the Qs, you would probably see that the Qs are going down. So that brings me back to one of the earlier slides that I gave in explanations. The second is pullbacks. So this is actually my favorite setup, where I'm essentially trying to trade a wedge that's going down and it breaks the wedge. And the benefit of this pullback, or when it pulls back to let's say the 20 EMA, is that I know that we're in an uptrend, so I still have the wind in my back, but I can get in cheaper and I can get in before all the others try and buy the breakout. So I actually have a tighter stop, a better risk to reward, higher R multiples. And this takes some practice because pullbacks are way trickier to trade than breakouts, but it does work. And then the third is, I like to trade reversals, mean reversions. I'm not going to go into all the details for that now. That's maybe for another time. But essentially, I'm looking for situations where we're extremely oversold or extremely overbought. And the probability of price snapping back, like, imagine like I'm pulling a rubber band and it snaps back, is in the absolute top tier percentile, right? Like we're talking like there's a 99% chance that this thing is going to snap back in the next 2 to 3 days. And this is great for trading options as well, especially short-term options. Traders that I use for this as well, and that's basically developed on years of trading FX. It was the only profitable strategy that I found in FX after trading it nonstop for 6 years, basically. But yeah, those are my main setups, and this is what I look for. So maybe that helps you as well. Let's talk about managing your trades, right? Because taking the entry is only half the story. Now the goal is to essentially stay on the wild horse for as long as possible, right? And I think it was Jesse Livermore who said most of the money is made in the waiting. So this is an art form in itself. When you're in a good position, your job is to do absolutely nothing except manage it properly. But managing it properly is actually a lot more complicated than you think. It's almost an art rather than a science. I'm trying to turn it into a science, to be honest, and this is what I found works. And this is also what me and my mentor talk about all the time, to be honest, and he has great ideas on it. But essentially, right, the first is that you want to take partials. So you trim your position. If you entered a position with, let's say, $5,000 and you're now up like 1,000, maybe take a little bit off the table, and you keep doing this, right? Especially as you are extended from the 50 based on a certain number of ATRs, right? And an ATR stands for average true range. It's a bit complicated to explain in this slide alone, but essentially when price is extremely overextended, so I'm talking about, let's say, the 7R. So this is 7 times distance from the 50 moving average, statistically speaking, less than 10% of stocks are going to continue after that. So that's where you definitely want to trim your position. And your stop to break even. Now, I'm a tight trader, so I like to move it very, very quickly. Maybe too quick because I also get stopped out sometimes. But the whole goal is, once you're around, let's say 1.5 to 2R or 1R, that you move to break even or at least a little bit above it. So for your R multiple, because now you're not risking anything, the position is free, and you should give it enough room to breathe. That's why I prefer to use 1.5 to 2R instead of 1R. The problem with 1R I found is that often price will break out, but it will pull back and it will stop you out. So I don't want to have that. So I need price to make a bigger move. Then I can safely move my stop to break even. Then I might take some off, right? And then the third is, question that I get asked a lot is, okay, but when do you fully exit? Well, you don't. You let the market decide because you don't know how long it's going to go. This might be a new SanDisk. This thing might go up 50x. Like you just don't know. You're just making assumptions. So I don't want to be predictive. I want to just react to what I'm seeing and have a system in place to support it. And that means that I trade it either with the 20 moving average, close below the 20 moving average, or the 10. If it's a very high momentum stock, you will often see trading above the 10 or the 5 moving. So it breaks the 10. Usually the momentum is kind of gone there and I just want to get out of it. I would not necessarily trail with the 50. It's way too wide for most stocks. So I would just use 20. There are more advanced ways of doing this as well. For example, you can trail using a 6 MA low of the day or close of the day. Close of the low of the day. That will be a bit more flexible, but generally speaking, right, this is how you do it. Then let's talk about position sizing. And again, just as a reminder, there are 20 points in total, so we're almost kind of there. And again, if you want to check out what I'm building on the side as well, make sure to check out SpiceLiner. But I trade full time. SpiceLiner is based on a lot of things that I'm actually explaining and showing you right now. So let's just talk about position sizing now. Think of it as, you have X number of bullets. And what you want to do is you want to prevent you getting killed, i.e. the risk of ruin. You want to have peace of mind so you can sleep nicely at night and you're just feeling calm and you don't check your phone all the time to see what the stock is doing. That leads me to, generally speaking, for most people, I would say it's best to risk 1 to 2% of your accounts. If you have a very high risk tolerance and a very high win rate and or probability of something working out with great R multiples, can you risk more? Yeah, of course. But for most people, this is going to work just fine. You can do very well with this. That also brings me to number 4, which is exposure. Some people like to have built huge conviction around 1 or 2 stocks and they just basically put half their portfolio in one stock. And I'm not saying that's wrong or right. I'm more of a trader like that. But others, they like to have 20 positions open. I don't work like that. I like to have high conviction bets and maybe have 4 or 5 positions simultaneously. But my point is that you need to find out what works for you, right? And be aware of your total exposure. So I'm always thinking, okay, how can I protect my downside? And if, hypothetically, there's a nuclear bomb dropped on Manhattan today and everything tanks and it gaps down, what's my absolute maximum down exposure, right? Like what's my total exposure? What's my maximum downside? That's how I'm thinking. That's how I'm allocating. And then the last one is, you're playing to win, meaning that when you're taking a shot, try to be a sniper, be more selective with your setups, with your stocks, with your criteria, so on and so forth, because that's how you actually win the battle. And because you win a battle over and over and over again, you tend to win the war, right? Last little chapter talking about essentially the, what I call the human side of things, because trading can be very mechanic, even though it's very discretionary as well. So this is a bit more personal, but I think it's important to cover as well. And then we'll be done with this. So let's just move. Here we go. I think this kind of sums up how I at least feel about trading and what I'm reading a lot as well. Nobody will understand. That's basically what it comes down to. If you're lucky, a few will understand what you're doing. People are used to exchanging time for money, i.e. a job. People are used to making promotions. People are used to having colleagues. People are used to dressing up in a suit and going to work and then commuting back and forth. People are used to, doing something that's visible. They won't understand trading. 99% of people are not going to basically give a fuck. They don't care. They don't understand. You can't talk about it with anyone. If you are having mad drawdowns, nobody will understand. You're completely alone in your own grief and you only have you to look at in the mirror and blame. That's basically it. So it's very lonely and you need to be wired like that. Like I can be very social, but my default state is like I'm much more of an introvert, right? I love sitting on a Saturday at home, even when the sun is out, and just having my coffee and just going through the charts. I love doing that stuff. Of course, I get outside and I socialize, but this is my default state. And I think if you're very extroverted, this is really not going to work for you. Even though you think it's fast money, it's not. It's probably going to fuck you. So, just be aware that trading is a very lonely journey. If you're lucky, like I was, you'll meet a couple people online. where you can exchange who you can exchange thoughts with and who you might resonate with. But even online, to be honest, it's a bit of a nasty world out there because a lot of people, and I've noticed it a lot when I post on Reddit, you get a ton of hate. There, it's just people are projecting their own insecurities or whatever, and you get a ton of hate of supposedly your people, like your fellow traders, right? And it's just very sad. So like I'm good with it. I'm in my 30s now. When I was in my 20s, this really mattered to me, but I really couldn't care less anymore, to be honest. But I just want to point it out, like this is a lonely journey, and you need to be very resilient if you want to succeed. Let's talk a bit about blowing up accounts. I wrote about, stories that I have had myself blowing up accounts and also what I've seen with one of my first trading mentors. The TLDR is that like this can really ruin your life. And if you went completely retarded and you just, you know, messed around with naked calls or whatever, naked shorts, and now you're like a couple 100K in debt, like it's basically the end of you, honestly. So, that's why stocks are good, or options like basic calls and shorts, or short calls and puts with a fixed risk, because in all other cases, you're just going to ruin yourself, honestly. And I think these are three things to be aware of in terms of blowing up your accounts. The first is obviously we all know that ideally you have cash flow coming in from some other source, right? Could be a job, could be another side hustle, could be consulting, whatever it is. Could be just savings, 1 to 2 years. One is very, very tight, but it's 2 years of savings, I would say, is good to give this a proper shot. Otherwise, you do it part-time until you can do it full-time. The second is being aware of your own emotional state. Now, I'm a journaler. I don't journal about my trades, but I journal about my own self. I do a lot of introspection. I've been doing that for 14, 15 years. So I have a very high meta awareness of my own emotional state, which allows me to basically not tilt. But it took like a decade to develop that after I blew up again, So a lot of people, you will need to work on regulating your emotions even better than you are doing right now. Or you become an algorithmic or fully mechanical trader, and that's a whole nother journey in itself. I'm a bit somewhere in the middle, but that's another story. And then third is, you want to protect yourself. You want to protect your sanity, your emotional state of being, your happiness. This is not worth losing everything over, like ever. And there is not a single trade, even if it's going to make you 10, 15, 20 million, that's going to worth you basically giving everything up in the hope that it's going to work out for you. Again, that's the gambler's mindset that I don't think you want to have. You want to be a speculator. It's very different. So you need to protect yourself. You need to protect your mental health. To me, that's exercise. I love going to the gym and doing yoga or like playing paddle or running or whatever. And it allows me to decompress because it's a very intense thing to do. Even if you're swing trading, like, you're always studying or you're always trying to check your watch list and refine things or looking for setups. And now you have a drawdown or now you're making big gains, but now you need to manage the trade. This is something that takes time. And it's kind of like a computer where 90% of the memory is just being used. So you need to protect yourself and be aware from a bigger, state of awareness that there's a lot of other stuff that you can do to manage your own health, both mentally, physically, and spiritually. I think we could talk about this for a long time, but I'm gonna keep this very short. If you look at what great traders have in common, apart from creativity and high conscientiousness and very low neuroticism, is that they're tinkerers. They love to, always work and always refine stuff. Like they're I think they're actually either tinkering or they are somehow trying to make things simpler for themselves. The thinkers tend to diverge. I'm much more of a person who is converging, right? So I'm always asking myself, do I really need this? Is this really essential? Or could I have the same information if I do it like this or like that? So, again, that's also what I'm trying to build with Spiceliner to help people more. But yeah, the whole point is that, I think great traders, what I have always read in books as well, between the lines, is that they're obsessed with their craft. And there's one trader called Simon Bouzos in the Market Wizards who made around $500 million in the market trading. And he is still writing and talking about refining his craft. I mean, this is just amazing. So, he's trying to essentially solve whatever problem in terms of trading he's trying to solve now through iteration. So I need you to adopt this mindset as well. And this is a great picture of Bill O'Neill, one of the MVPs, of course, of trading and investing. He wrote the book How to Make Money in Stocks, an absolute must read for anyone interested in taking this seriously. But, this guy who was absolutely crushing the market, doing it year in, year out for decades, and he was still studying. He was still, they didn't have computers like we do at the time, but he was still going through charts, highlighting them, talking with his personnel, sourcing ideas, trading ideas, all this sort of stuff. He was constantly studying. And I think that's something that you don't read about a lot about online or anything. People don't mention it. But this is also a job or a business where, you need to study like your fucking ass off, especially if you're starting out. It's going to take years. And When I say years, I really mean that. Like, I'm a very fast student. I can learn, like, I used to read 1 or 2 books a day. Like, that's no problem for me. And it still took me, what, like 8 to 10 hours of full-time studying and learning and reading and watching stuff to like bring it all together and synthesize it in my mind. So I don't want to intimidate you too much. I mean, I don't want to overcomplicate it, but I do want to emphasize that, you know, you need to study. There's no way around it. The great thing is that eventually you can do a lot less studying because now it's kind of you, right? Like you found your style and you've put in the work. So it is very important. I'm not going to go through all the resources and tools, but these are the ones that I would advise anyone to check out if you're really serious about this stuff. You know, I decided not to cover brokers, to be honest, because that's so dependent on many things. But yeah, these are great resources for you to check. And I would highly encourage anyone to make a note of these and just go through them one by one and see if it does anything to you. And then I'm not going to go through all the points, but you know, just a couple. And this is kind of what I call the short summary for the lazy. You know, basically, this is going to take longer than you think. Studying is not the same as learning. You need to stop buying garbage and follow strength. Most indicators are BS. You need to keep your tools and platforms simple. You need to build a process. Trade based on your personality, what comes natural to your brain and your lifestyle. Let the market tell you what it wants to do. Understand that money moves in sectors and there's industry and sector rotation. Understand that the winners keep winning. Scan for quality, uptrends, good fundamentals, so on and so forth. Be aware that the big winners need catalysts, fundamentally, macroeconomic, or a story. Trading is a lot about probabilities. You need to master a few setups, you know, so on and so forth, right? I'm not going to go through the whole list. I kind of already did. But yeah, one more point that I do want to emphasize on this list. If you look at number 21 and 22, I guarantee you a lot of people, especially on Reddit, that's exactly what they're going to do. Yeah, they're going to basically blah, 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 blah. They're going to scan, which is understandable. It's a long video and post. But they think that the TLDR is enough. Oh, now I understand it. No, you don't. You don't understand the nuances. And trading is about nuance, understanding why you need to buy it here and not there, even though it looks exactly the same to a beginner or an intermediate trader or investor. Yeah, so you need to stop cutting corners, put in the work, put in the effort to make it happen. And then maybe, you know, maybe it's going to work for you. I hope it does. I think more people can do it than they think and then that the media tells you, because they will tell you to basically ETF and chill. But I also think that, and I'm not one of those traders yet either, but I think there are only very few people very suited to become one of the greats, right? One of the legends, one of the market wizards. So yeah, that's kind of it, guys. I hope it was a long video, but I hope it was helpful to you. If you like this, I really encourage you to have a look at what I'm building over at Spiceline as well. I'm not going to go into all the details, but essentially I'm building an open platform for people to trade on based on a lot of things that we discussed. And the beauty of it is that behind the scenes, I'm working on something absolutely epic. So the more people that I can get to use it, and it's basically free, the more feedback I can get to make the next version absolutely epic. So make sure to check it out. And yeah, if you liked this video, if it was helpful, it gave you an idea, feel free to reach out. It would be great if you share it with others as well. I put a lot of time and effort into writing it and you know, visualizing it in a way where it makes sense to you, hopefully. But yeah, if I had kids, this is what I would do. And these are the lessons that I learned based on 11,000 hours of chart time, 8 years of experience, a lot of trial and error, and going through all the reading, watching, and studying that you are either doing or you are about to do. So yeah, let me know what you think, and I'll see you in the next one. Cheers.